Hello, welcome back, guys. I hope you're having a nice Saturday. I'm generally speaking closely monitoring trends in the markets, which kinds of companies and stocks are being discussed a lot during the day. And whenever I see something that is out of the ordinary and I'm looking at some stocks that are potentially trending, I want to be making some videos and pretty much examining those. Now, one of these companies is a company for which I've talked about in the past as well. I've made another video. It's called Solo Brands, and we can take a little bit of a look in case you're not aware, because this is a very small company over here. It is a company that operates a direct-to-consumer platform and offers outdoor lifestyle branded products in the United States here. So, like grills, cooktops, tools, and things of that sort. So, an interesting company that is currently trading at a $300 million market cap. Now, we do want to examine the financials, of course, even though this is trending in the short term. I mean, it may be prime for short-term moves, because if it's a good opportunity to buy for the long term, we may even benefit from the short-term run over here and just get some extra value from our shares. Now, the thing is this going to be a long-term buy as well? It is what we're going to be examining in this video, if it makes any sense to be buying this one and hold it for a long time. Now, you will see here that the 1 year high has been at 23 almost bucks over here, a little bit more, and it's down 80%. And when this happens, you can see that it's been pretty much going down and down lately. When this happens, there may be a time that the stock actually will reverse and go back up if it is a good value. So if the company is actually selling a lot, if they're making good cash, good free cash flow, and the stock is cheap, it may be prime for an upwards movement. And so this is why it's beneficial to examine these companies. Especially these smaller ones can have a lot of potential, hype and a lot of potential room for moving upwards. So you will see right now that the P ratio of the company is very high. This points to the company pretty much having a very, very low amount of net income compared to the price of the stock. So this points to pretty much an overvalued company, but we will see that in more detail. And the price to free cash flow is even negative, so the company is not making a positive free cash flow here. But at least it's not actually issuing too many shares over here. So it is a company that has issued 3% more, but that's not too much. So they don't seem to be diluting shareholders significantly here. So even though this is an X, it's not a massive X. It's almost like a green here. Now, the thing is, the company has been increasing their revenues nicely. And they're at a point where the revenues over here are sitting at 400 million, which is fairly solid for a company of this sort. Yet their net income is also going upwards, but it's still in low territory. So we need it to be at a higher level, really, to make sense for us to be buying this stock for this current price. Now, the free cash flow is in the negative. We will examine why this is happening. And the total equity growth has been growing. The company has been growing its equity, which is also another thing to see. So the company doesn't seem to be, getting too much debt here, which is also nice to see. Maybe they don't need that, or maybe they are full in terms of inventory. We can actually examine again all these things in a little bit more detail later. Now, it's worth noting that if we're talking about a company that is not making free cash flow, we at least want it to be having a low price to sales ratio, which this company has. It's sitting at 0.7 right now, which is actually fairly attractive. This means that the company is generating quite significant amounts of revenue compared to its current price, its current stock price, and that is a nice thing to see. So if you have a non-profitable company, the next thing that you want to be seeing out of these companies is to be having a low price to sales ratio, for example, which kind of helps because it points to a company that has much potential, some important potential compared to its current price. Because when the company is making that much in sales compared to how much it's valued, it can kind of make it a little bit better in terms of its operations and gain some more net income, gain some more free cash flow. It has more leverage, more than likely. Now, the debt to equity ratio is low as well, 0.2. Again, a company that looks fairly solid in terms of debt here. The same thing with the current ratio, pointing to current assets divided by current liabilities here. So many more current assets than the liabilities that the company has for the next 12 months is what this points out to. Now, The next thing that I want to examine is a little bit more in detail about the financial statements. This matters a ton because you can see that the company's revenues have been growing very nicely. And again, this is a tremendous growth over here, and you love to see that as a potential shareholder here. In terms of net income, they have also been growing at positive territory. So while they are not making tons of net income, and the stock may be a little bit more expensive here, it may be an interesting growth story if you can at least get it at a fair price, or at least get a little bit at a fair price. Now, the balance sheet of the company is pointing to total equity of 500 million here, and in terms of total liabilities, half of that, 260. And if we're talking about cash flow, which is super important, of course, you can kind of see here that the company is going into negative territory, because for the most part we are looking at change in working capital and inventory. So the company is getting some extra inventory here back in 2021, that is. Now, this may be a little bit problematic because if they bought this inventory in anticipation of sales happening because of the stimulus check in the US, this can actually be problematic because they may be having some extra inventory pretty much stocked up, piled up. But this has a lot to do with how quickly their inventory depreciates, if that depreciates indeed, and also how quickly they can turn it over. Very, very important thing to see. And also a change in working capital here. Working capital is basically defined by current assets minus the current liabilities that the company has. It is pretty much a metric that tells us about the company's liquidity at any given point, really. And also this means that there was some cash outflows here in terms of current assets and current liabilities that the company has. They may have gotten some extra debt, for example, that has to be fulfilled in the next 12 months or so. Okay, that's not worrying necessarily, of course. It's important to also notice that in terms of investing activities, the company has just a little bit in terms of capital expenditures. Again, this is a very, very small company, so you shouldn't be expecting high expenditures here. It's only an acquisition here. It looks like it spent quite some quite some money here. And in terms of financing activities, they are in the positive here because of some extra debt it looks like they're getting over here. And also it's still issuing a little bit of common stock. They could potentially be issuing even more if this sales go south, I suppose. And they do have about 25 million in terms of cash. Free cash flow at the end of 2021 actually was at minus 20 million. And this is something that, of course, you don't like to see, but remember, this was affected a ton by the change in inventory and change in working capital. So this more than likely didn't need to happen, frankly speaking. So you could easily be seeing this value being in positive territory here, and you could very, very easily see the free cash flow being back at 30 million or 20 million or 40 million. Now, it's worth noting, and it may be useful to take a little bit of a look at the quarterly, because it can tell us a little bit about how the free cash flow keeps changing here. So some years positive, some years negative. It again seems to be affected by what the company is deciding in terms of changing working capital here and inventory. But overall, it's been going up and down quite a bit. Okay, so in terms of our stock evaluation tool, what can we do here? Obviously, the company has been having tremendous revenue growth. We cannot really go that high, but we can still go high and assume that the company will keep on growing pretty precipitously for the next 5 years. Let's just do that. Now, in terms of net income margins, the company has had some rough years, but lately they have been achieving, profitability, as you will see here. Now, the margin has been like 2%, 2.6%, and seems to be sitting at about 1-2%, something of that sort. So I'm actually going to go a little bit low here. So 1.5, and 2 is what I'm going to try. And in terms of the free cash flow margin, all over the place. Remember, we talked about it. A lot of changes in, dependent to inventory or changes in working capital. Overall, you are looking at companies that eventually balance themselves out at near 100% in terms of their free cash flow margin. We do want to go somewhere around that level, so I'm going to go 80, 90, and 100. And in terms of the annual return, is 13% is what I would typically want to see. And I can really see this company potentially achieving these kinds of projections here for the next 5 years. It's not out of the ordinary, frankly. Now, when we hit calculate, what are we getting? So yeah, it's our high estimates that are sitting at a green at the purchase price right now, with the current price being at 4.76. Our high estimates are already there, but our high estimates presuppose a 50% revenue growth and a 2% net income margin, which converts to free cash flow at the same rate. So this is ambitious, to say the least. This definitely is by far the most ambitious projection here. It may happen. It wouldn't be too unlikely, but it does carry some risk. Now, yes, the fact that the company has a low price to sales is something that I like. I talked about it a bit. And overall, the company is not massively expensive, but it is still a little bit overpriced. Now, is this a terrible buy? I don't think so. I mean, I could definitely see someone entering this one, especially if it goes down a little bit more. Because right now it is having a little bit of an uptrend. It's probably going to be at about $5. But if it has a little bit of an extra downtrend at some point, for instance, over here was 3.89. So somewhere around 350 or something of that sort could be a very, very interesting entry point, actually, just to get a little bit and let it run over the years. Remember, this is also a retailer. It's going to be pretty cyclical in nature here, depending on how the whole economy will be moving. So it may be a little bit of a potential risk here because of the current downtrend in the economy, adding this one to a portfolio. But still, it may be beneficial to add to a watch list, just to watch out for a potential buy, a potential purchase of this company, especially when the markets and the overall economy turns again for the better. It may be a beneficial company to add to a portfolio. Again, when we are going back to normal territory, when inflation is down, potentially this could be a very, very interesting buy. So even though I'm not buying right now, I'm really, really keeping this one in the back of my mind for a potential purchase a little bit later. Thanks for watching the video, guys. I hope you enjoyed this one, and I'd love to see you in our next video. So in order to do that, please remember to subscribe, and also, if you enjoyed this video, leave a like. That helps a ton. And in the meantime, take a look at the video that I made earlier. I'm discussing Bed Bath & Beyond, which had a massive short squeeze. Very, very interesting video to watch. And thanks again for watching this one. I'll see you in the next one, and have an awesome weekend. Bye-bye.